Greetings, everybody. Welcome to Liberty Call. Let me adjust my camera there. Welcome to Liberty Call. I am Raymond Dahlman, your humble host. I hope everyone's having a fantastical day out there in the interwebs. It is a beautiful sunny day here in Colorado. A little warm, but we're on that heat dome or that hot weather that's over the Southwest all the way over into Texas. We're kind of at the top of that, so it's still a little warm today. What's the temperature right now? Says it's only 78 degrees outside. Let me check my phone. I don't think that's right. I've been out a few times and let's see. Looks on my phone says it's about 85 degrees outside. So anyways, you didn't come here for the weather forecast in Perry Park, Colorado, did you? No, you didn't. Anyways, all right. If it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, hit the share button, the like button, the follow button, all the little buttons on the screen. Give me some thumbs up. I'd greatly appreciate it. All right, let's go ahead and jump into the numbers. I've done my, whatever that's called, call to action. So, all right, Dow Jones finished the day up only 0.14%, closing at 47 points. Up 47 points, closed at 34,395. The S&P 500 was up 0.83%, closed at 4509. NASDAQ was the big winner today here domestically, up 1.58%, closed at 14,138. The VIX was up today 0.3%. It's currently at 1358. Canada was up 1.03%. Brazil was up 1.42%, and Mexico up 0.55%. In Europe, Germany was up 0.74%. The UK was up 0.32%. France was up 0.5%. Netherlands was up 0.87, Spain up 0.26, Italy up 0.78, Switzerland up 0.02, so basically flat, and Portugal up 0.6 for the day. Russian exchanges were split today. MOEX down 0.39, the RTSI up 0.36. And the overnights in Asia see all greens today, finally. The Nikkei in Japan was up 1.49%. Australia was up 1.56%. New Zealand up 1.17%. In China, the Shanghai was up 1.26%. The Shenzhen component up 1.61%. The China A50 up 1.87%. DJ Shanghai up 1.19%. Hang Seng up 2.6%. And the Taiwan weighted up 0.59%. All right, so that's the world markets for today. Definitely a lot better than the last couple of days. You can see my boy Jake back here. He is ready for some playtime. He loves playing ball. Right, Jake? And he's like, quit talking about finances. I'm here just for security and to entertain you between meetings and reading articles and stuff like that. All right, let's go ahead and jump over to the market recap. S&P 500 climbs as Alphabet leads rally in tech. The S&P 500 continued its upward momentum on Thursday, driven by strong quarterly earnings and a surge in technology stocks following Google's launch of its ChatGPT rival, Baird, in Europe and Brazil. PepsiCo reported better than expected quarterly results, with price hikes helping to offset higher input costs. The company also raised its full-year outlook, leading to more than a 2% increase in its shares. Delta Airlines also delivered record quarterly results that surpassed Wall Street estimates. However, sentiment on the stock cooled as the airline noted that capacity constraints were expected to persist for an extended period. Alphabet, the parent company of Google, saw its stock rise over 4% after launching Bard AI in Brazil and the European Union. The move is seen as a step toward competing with ChatGPT in the field of artificial intelligence. Analysts believe that Google Search, which contributes significantly to Alphabet's revenue, will become more personalized and develop critical competitive advantages as the company continues to invest in AI. Meta Platforms, the company behind Facebook, experienced a boost in sentiment after announcing plans to release a commercial version of its AI learning model. The upgrade from TD Cowen to outperform further enhanced expectations for the company's performance, driven by cost cuts and increased monetization from features like Reels and Threads. In terms of economic indicators, inflation showed further signs of slowing, with producer prices in June growing at a slower pace than expected. This suggests that policy initiatives are effectively curbing inflation slowly. Let's see, particularly on the producer side, however, weekly jobless claims fell more than anticipated, indicating that the the labor market remains strong and may not deter the Federal Reserve from raising interest rates as expected. Are you noticing a trend? I mean, I know I cover these articles every day, and the trend is always, when is the Fed going to lower rates? When is the Fed going to, cut rates? When is the Fed going to print more money so that I can go buy more stuff, with fake money? Why is everyone in such a damn hurry to get interest rates back down to zero? We're dealing with the problems of that basically going back to the last financial crisis we had back in 2008 and 9. The interest rates were held artificially at zero for till 2016, I think. I just, it boggles the mind how the people, these financial journalists, are in such a hurry to go back to the problem that created, or to go back to the solution that created the problem we're dealing with right now. I mean, seriously, folks. All right, finishing this up, Amazon also contributed to market gains with its stock rising over 2% following the announcement that U.S. online sales during the Prime Day promotional campaign increased by 6.1% to 12.7 billion. The event set a record with 375 million items sold worldwide. Did you do your part? I think I ordered some taco seasoning, and some Gatorade. And something else. Oh, vitamin K. It's good for you. Overall, positive earnings reports, advancements in AI technology, signs of inflation cooling, and a strong consumer spending during Prime Day contributed to the continued rally in the S&P 500 and technology stocks. All right. Well, everyone's feeling good today. Where'd my buddy go? Oh, he's down here under my feet. All righty. Well, let's go ahead and move over to economic data that came out today. U.S. producer inflation muted. Labor market is still tight. The U.S. producer prices showed minimal growth in June, indicating a period of disinflation. Again, that's not disinflation. Disinflation is when it heads in a negative number. This would just be flat, indicating a period of disinflation in the economy despite a tight labor market. The report from the Labor Department suggests that the Federal Reserve's monetary policy tightening campaign may be coming to an end. The Producer Price Index, or PPI, for final demand inched up by 0.1% in June, with May's data revised to show a 0.4% decrease instead of a previously reported 0.4% decline. On a year-on-year basis, the PPI increased by 0.1%, the smallest gain since August of 20, following a 0.9% rise in May. The figures fell short of economists' expectations. The slowdown in inflation can be attributed to the disappearance of supply chain bottlenecks and a decrease in demand for goods due to higher interest rates. Additionally, the surge in prices seen last year is no longer factored into the annual inflation calculations. The Federal Reserve is anticipated to raise interest rates later this month, but economists believe it could be the final hike of the current cycle. With the economy slowing down and some margin of slack appearing in productive capacity, the risk of further upward pressure on prices seem less likely. While the labor market remains strong, weekly jobs claims fell more than expected, signaling continued tightness in the job market. However, this may prompt the Fed to focus more on labor market conditions rather than just top-line prices when making future rate decisions. In terms of specific sectors, services accounted for the rise in monthly PPI, increasing by 0.2%. Notably, deposit services, including checking and savings accounts, surged by 5.4%. Meanwhile, goods prices remained unchanged, with energy prices rebounding by 0.7% and food prices declining for the third consecutive month. Core inflation, which excludes food and energy components, slowed down as well. Core goods prices fell by 0.2% in June, while the narrower measure of core PPI rose by 0.1%. On a year-on-year basis, core PPI advanced 2.6%, the smallest gain since February of 21. Despite the easing inflation, the labor market continues to show strength, with the initial jobs claims dropping to a seasonally adjusted 237,000. Demand for labor remained healthy in June, although some reports indicated targeted and selective hiring. Overall, the data indicates a slowing inflationary trend accompanied by a robust labor market. The Federal Reserve will closely monitor these developments as it determines its future monetary policy actions. So there we are. All right, last up, it's an article from Zero Hedge titled, "Even if Jerome Powell is successful, we still lose." And this was written by Jeffrey Schneider via Real Clear Markets. The battle between the Federal Reserve and the bond market continues, with each side delivering blows to each other. The Fed, through its rate hiking regime, attempts to influence the behavior of the bond market. However, the impact is limited and murky, particularly around the 2-year spot. The fight started when Chair Jay Powell declared in late 2021 that inflation was no longer transitory. The bond market disagreed, recognizing the supply shock and viewing it as temporary. Initially, the Fed's rate hikes were met with token resistance from bonds. In June, the battle intensified as the Fed increased rate hikes while inversions spread and deepened. The fight reached a critical point in September and October when a trigger event led to a strong response from the bond market. However, the Fed fought back with a tactic of forward guidance, tying economic data and consumer price measures to the need for higher interest rates. Bonds initially responded by raising yields, but within weeks they countered with a massive swing of their own, the banking crisis. This stunned officials into silence and led to plummeting market interest rates. The conflict between the Fed and the bond market revolves around the concept of interest rates. Economists believe that the Fed should raise rates to fight inflation, even though history has shown that interest rates tend to rise during genuinely inflationary periods. Bond market participants resist these notions and view falling rates, especially from a low start, as a sign of economic weakness. The events in September and October revealed a collateral run characterized by a surge in demand for usable currency and top quality collateral. This collateral strain impacted repo and derivative markets, leading to increasingly unfavorable lending terms and deeply negative repo rates. The consequences of the collateral run, along with the subsequent failures of SVB and Credit Suisse in March, dealt a significant blow to rate hikers and policymakers. It highlighted the deflationary consequences of higher interest rates and the demand for safe and liquid assets such as government bonds. When the Fed attempted a comeback with the release of minutes from its mid-June meeting announcing a commitment to further rate hikes even in the face of a recession, the bond market remains resistant. Inversions persist, signaling strong opposition to rate hikes. The bond market is waiting for the next opportunity to counter with collateral likely tied to commercial real estate and commercial mortgage-backed securities. This fight is far from over, and the market is preparing for a final fight-ending uppercut. Ultimately, the outcome of the battle will not bring the desired end to inflation. At best, it may result in a modest contraction of transitory consumer price pressures. The true nature of the fight lies not in how it ends, but in what it represents. The battle was never about neutrality. It was about the inflationary pressures and the fight against them. And that article is linked in the show notes. So if you want to read it in its entirety instead of just my summary, you are welcome to go do so. All right. Well, that is everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.